Look at the screen right now. The S&P 500 is near its highs. The Dow is breaking out. Bitcoin is bouncing. Solana is accelerating. Strategy stock just jumped almost 8%. Easy conclusion. Risk is back. Now zoom out. The Nasdaq is losing momentum. Nvidia is trading below its short-term averages and sitting dangerously close to its long-term trend support. Tesla has just printed violent downside. Bitcoin is recovering, but it is still far below its 200-day exponential moving average. The dollar remains structurally firm. And while crypto is trying to bounce, Citi has cut its 12-month Bitcoin target from $112,000 to $82,000, cut its Ether target, and reduced its assumption for net ETF inflows over the next 12 months to zero. At the same time, Strategy has introduced a framework that can monetize Bitcoin. Metaplanet is still accumulating and now reports 43,000 Bitcoin. South Korea, one of the purest public market expressions of the AI infrastructure boom, has just shown how quickly crowded chip exposure can turn into violent selling. These are not separate stories. This is not risk on. Capital is being ranked. Most investors still use a binary framework, risk on or risk off, bullish or bearish, money in or money out. But the market in front of us is doing something more selective. Look at the charts. The S&P 500 remains above its short-term averages and its 200-day trend. The Dow is even stronger, pushing into new highs with momentum elevated. But the Nasdaq is softer. Its momentum has deteriorated. Nvidia has lost its short-term trend. Tesla is unstable around long-term support. Apple, meanwhile, has exploded higher with strong volume. That is not broad participation. That is internal selection. A market can rise while risk appetite is narrowing, and that distinction changes everything. Now look at crypto. Bitcoin around $62,500 has recovered above its fastest daily average, but it remains below the next short-term trend level and far below the 200-day exponential average, near 75,700. Ethereum has improved. Momentum is recovering, but the larger structure is still damaged. Solana is the most aggressive of the three in the short term. Price is above its fast averages. RSI is strong. Momentum is expanding, but even Solana remains below its 200-day exponential average near $97 and is moving directly into a heavy supply zone. So yes, crypto is bouncing, but no, the long-term structure has not been repaired. That is the first mistake retail makes. A green candle is not the same thing as returning liquidity. The Federal Reserve is the next piece of this puzzle. Kevin Warsh has acknowledged that inflation expectations and inflation risks have eased in recent weeks. That reduced immediate pressure. Markets heard a lower probability of another near-term policy shock. But Warsh also defended the 2% inflation target and refused to promise a path for rates. That matters. The Fed did not open the liquidity floodgates. It simply reduced the probability of another immediate shock. Less pressure is not the same as easy money, and your dollar chart shows exactly why. The dollar index is still above its 200-day exponential average. It is still holding a structurally firm regime. So the simple story, softer Fed, weaker dollar, liquidity explosion, everything goes up, does not fit the evidence. Liquidity is available, but access to it is becoming conditional. That is the hidden mechanism. Capital is moving towards structures that can justify the allocation. Sometimes that means visible earnings, sometimes cash flow, sometimes balance sheet resilience, sometimes scarcity with a real buyer, sometimes a company that can survive financing stress. And sometimes it means leaving a crowded trade even when the long-term story is still real. Now consider artificial intelligence. AI is real, the capex is real, data center demand is real, high bandwidth memory is real, the infrastructure build-out is real. But a real theme can still become a fragile trade. South Korea is the perfect example. Samsung and SK Hynix sit at the center of the global memory chain. Investment plans are being built around future AI demand. Yet when expectations around computing capacity and future supply shifted, the market reaction was brutal. This is what crowding does. When too much capital owns the same future, even a small change in expectations can create a violent repricing. And the mechanism is not simply fear, it is positioning, leverage, passive concentration, risk limits, margin pressure, funds reducing the same exposure at the same time. When a trade becomes crowded enough, good news and bad news stop producing normal moves. They produce reflexivity. The theme can remain real while the trade becomes dangerous. Now connect that to Bitcoin. Bitcoin has a structural supply story, but price expansion still needs a cyclical demand engine. Citi's downgrade matters not because one bank has become bearish. It matters because the bank is questioning the reliability of the marginal buyer. Its new framework assumes zero net ETF inflows over the next 12 months, down from a previous $10 billion assumption. That is the signal. The institutional transmission channel has weakened. Bitcoin can still rally. Scarcity still matters. The long-term thesis can remain intact. But scarcity without incremental demand does not disappear. It simply stops repricing. So the question is not, can Bitcoin bounce? The question is, who funds the next leg? And now strategy becomes one of the market's most important charts. The stock jumped almost 8% to around $100 after its new capital framework. Retail sees the move and says, reversal. Now look at the structure. The stock is still below its 26-day exponential average near $115. It is still dramatically below its 200-day exponential average near $180. The catalyst is real. The reversal is not confirmed, but the deeper story is bigger. Strategy has moved from a one-way capital narrative toward active capital management. Its new framework can use a US dollar reserve, repurchases, preferred security management, common stock buybacks, and, under defined conditions, Bitcoin monetization. That does not automatically mean weakness. It means the machine changed. The old model was easy to understand. Issue capital, buy Bitcoin, hold, repeat. The new model is more complex. Issue when capital is attractive, repurchase when securities are cheap, protect liquidity, manage obligations. Monetize Bitcoin when that is more advantageous than issuing common equity. Bitcoin is no longer only the asset inside the machine. Bitcoin can become capital used by the machine. Now put strategy next to Metaplanet. Strategy creates flexibility to monetize Bitcoin. Metaplanet reports 43,000 Bitcoin and continues scaling the treasury model. Retail sees contradiction. There is no contradiction. There are different capital structures solving different problems. Strategy must manage a mature and layered capital stack, investor confidence, preferred obligations, liquidity coverage, and the relationship between its market value and its Bitcoin holdings. Metaplanet is still scaling treasury identity, market access, and Bitcoin exposure inside a different financial environment. Same asset, different machine, different behavior. This is why counting Bitcoin is not enough. You have to study the architecture around the Bitcoin. And that is the second mistake retail makes. Retail watches price. Capital watches financing conditions. Retail asks whether Bitcoin is up today. Professional capital asks whether the buyer is durable. Retail celebrates a corporate Bitcoin purchase. Professional capital asks what was issued, at what cost, with what dilution, under what obligations, and what happens if the premium disappears. Retail sees an index at a high and assumes the market is healthy. Professional capital studies breadth, leadership, and who is quietly losing access to liquidity. So what happens next? There are three paths. The first is real broadening. ETF flows improve, the dollar loses structural strength, Bitcoin reclaims higher trend levels, Nasdaq leadership returns, Nvidia stabilizes, crypto breadth expands beyond a few short-term winners. Then we can begin to talk about genuine broad risk appetite. The second path is selective risk. The Dow and S&P remain strong. Nasdaq leadership stays unstable. AI trades remain violent. Bitcoin bounces without a durable institutional flow engine. Solana outperforms tactically. Strategy rallies on capital management catalysts, while the larger trend remains damaged. In that world, the market keeps ranking assets. The third path is renewed stress. The dollar accelerates. ETF outflows persist. Bitcoin fails its recovery. AI deleveraging returns. Nasdaq structure weakens further. Then selection can quickly become generalized risk reduction. This is why the investor's job is not to predict one perfect outcome. It is to identify which mechanism is gaining control. At Block 2 Learn, this is the core of the framework. If you want to build that kind of market thinking, start with the Block 2 Learn learning path. Information is not the scarce resource. Structure is. A chart without liquidity is incomplete. A narrative without positioning is dangerous. A Bitcoin treasury without capital structure analysis is misunderstood. An AI boom without valuation and crowding is only half a story. And an index at record highs can still hide a market that is becoming more selective underneath. The market is not reopening the casino. It is checking who still deserves a seat at the table. This is not risk on. Capital is being ranked, and the next market leader may not be the asset with the strongest story. It may be the structure that needs the least belief to survive, not financial advice.